Hey everybody, it's John King, and thank you for tuning in for my weekly market update. It is Friday, May the 12th, and I've got a lot to cover today, so let's dive right in. The first thing I want to talk about is going to be what's happening with inflation. So we'll talk through the report that came out this week and what that means. We'll talk about interest rates. We're back down to 1-month lows, but what does that actually mean? We're going to talk about the FHFA's elimination of the debt to income risk adjustment. I'll explain what that means and specifically what that means to you. We're going to talk about the California Association of Realtors is pushing for $800 million in funding in the coming year for the Dream for All program. Is that going to happen? Where's that money coming from? I'm going to talk all about that. We're going to talk about more banks about to go under and what's really happening there. And then finally, I'm going to wrap up with my thoughts on what's happening with the debt ceiling issue. What does that really mean? And how is it going to impact mortgages? So we got a lot to cover today, so let's go ahead and dive right in. So first of all, inflation. Inflation is obviously the issue that's been driving interest rates up for the last year. There was a lot of talk about May 10th being a turning point. I've been talking about it a lot for the report that came out 2 days ago on inflation. And it did show that inflation has come down. And so as expected, we're seeing inflation moderating. It's now down below 5%. So that's really, really good. But there's a couple of challenges. First of all is employment is becoming the bigger issue. So inflation brought us up, but what we've got right now is a really red hot economy that's continuing to stay hot, and inflation is driven in part by employment. And as people continue to get jobs and continue to have jobs available to them, they're going to continue to be spending money. And it creates almost a double-edged sword. So the simple thing to think about is the Federal Reserve is looking for employment numbers to drop. And that is the most important thing that they're paying attention to in order for them to start lowering Federal Reserve benchmark rates. Now, the Federal Reserve rates don't drive mortgage rates directly, but they certainly influence mortgage rates. And so inflation, the biggest challenge now is what's called entrenched inflation. Entrenched inflation means people expect inflation to continue. Well, if you expect inflation to continue, if you're saying, look, inflation's here forever, then you're going to demand higher wages from your employer, especially in an environment where there's lots of jobs available. You can ask for higher wages from your employer, and your employer is going to have to pay them to you because you're like, look, I can't continue to live on what I'm making right now because cost of bread, milk, eggs is all getting way more expensive. And so I need to make more income. If I expect inflation to stay this high, then I've got to earn more money. But if your employer agrees to pay you more money, then your employer has to charge more for the goods and services that they're selling to everybody else. Therefore, it creates a vicious cycle where you ask for more income because inflation is causing your spending to have to go up. And your employer says yes, which means they have to charge more for things, which means that the spending becomes higher for everybody else, and they're going to ask for higher wages, and it creates a vicious circle. So realistically, employment is the number one factor right now that's going to drive mortgage rates and really drive the economy. And so it sounds really horrible to say it this way, but really what the Federal Reserve is looking for and what people in the mortgage and real estate industry have to look forward to is when job losses start racking up, when there are people who are unemployment numbers start increasing is the best way to say that. At that point, we're going to see relief. That's really what leads to a recession, and a recession is what we need as the relief valve to solve this issue. All right, second topic I want to talk about today. Interest rates have been falling this week, and that's really, really good news, but everything is relative. We're still in the mid-sixes. We still see interest rates kind of staying where they're at for the time being until we see employment numbers come down or unemployment numbers go up. But why do I talk about rates being at the lowest level in a month? Partially because most people get their interest rate information, other than you who get the information from me, they get their interest rate information from the weekly market survey that's published every Thursday. And so on Thursday, you're going to hear interest rates have gone up or interest rates have gone down. The problem is Thursday's report is based on data collected on Monday. Well, Monday of this week, interest rates were still up. They started coming down on Wednesday with the inflation report. And so what's funny is on Thursday, you're going to hear about interest rates. Yesterday, you heard interest rates being higher than last week when they're not. because the interest rates change every single day. And so to say, oh my gosh, rates are higher or hey, rates are lower, you got to be really careful about what information that you're looking at, because most of the time you're getting information that's anywhere from 3 to 7 days old, and things change very, very quickly. I expect rates to stay pretty similar to where they are right now until we get more employment data. And the most important employment data comes out the first Friday of every month. And that is the BLS jobs report, the federal government coming out and saying, what's the unemployment rate? And truthfully, if you're rooting for lower mortgage rates, you're rooting for higher unemployment. All right, let's move on to the next topic I want to talk about. The Federal Housing Finance Administration has eliminated one of the most controversial risk factors that they tried to add to mortgages earlier this year. And that was a risk factor based on your debt to income ratio. Now, there's been a lot of conversation over the last month about high credit borrowers being punished by having to pay higher interest rates than low credit borrowers. And that wasn't true. Go back to my videos and you'll see where it was not true. But this actually is very related to that. At the same time that they announced those changes at the beginning of the year, they announced a change that said, look, if your debt to income ratio is over 40%, you're a higher risk. You're going to pay a higher interest rate than somebody who's spending less of their income towards their bills. Logically, that makes sense. You are a higher risk, but it doesn't work in the mortgage workflow, because in the mortgage industry, the underwriter's recalculating your income all the time. And so if I tell you up front, hey, this is your rate because I think this is your debt to income ratio, the underwriter often will say, well, look, I'm gonna take a more conservative approach, but don't worry, the borrower still qualifies. Yeah, but now their interest rate is higher, and it reduces the confidence in the mortgage world, and it really makes it a challenging time for us to implement something like that. So the great news is that the FHA originally had postponed it, and now they've eliminated it. They said it's not going to happen. So if you knew anything about that, rest assured it's been eliminated. We've won that fight. Speaking of fighting, the California Association of Realtors is taking on the California budget and is trying to get back the money for California Dream for All that was lost earlier this year. So let me recap. The California Dream for All program is a shared appreciation loan that gives you up to 20% of your purchase price towards down payment. Amazing loan program. I helped 7 clients get loans using that program, and I was really disappointed that it ran out in literally 7 business days. But here's the 8 business days. But here's the deal. The state government had originally allocated $500 million. They cut it back to $300 million. I've announced previously on my YouTube channel that there is for sure another $300 million that is in the budget for starting July 1st of 2023 through June 30th of 2024. That budget year, there's $300 million allocated. Now, don't take that as meaning the money is available on July 1st. It just means that's the year I'm talking about that the money has been allocated. When CalHFA actually releases it, I don't know. Well, the California Association of Realtors is pushing all of their members to call their state assembly and everybody in Sacramento and say, look, you need to not only fully fund it with the $500 million that you've agreed to originally, you need to increase that number for this year to $800 million, and you need to give us the $200 million that you didn't give us from 2023's 2022-2023 fiscal year, the $200 million that took away. So basically, they're trying to get almost 3.5 times the amount of money. That would be huge. That would take a lot of the pressure off the program. And I do think the program might come out with some changes. That's speculation, but I think that they should decrease how much money they're giving to some people so that it lasts longer. If we could get $1 billion, that would be huge. So they're pushing to make this year's allocation not only back up to the $500 million, but actually up to $800 million for this year, and pick up the $200 million from last year to make it $1 billion. I'm not sure that's going to pass. Honestly, the money's got to come from somewhere. The state budget is not balanced. There's a deficit. And so although the realtors want to push for this, there's a double-edged sword, which is that it's going to push housing prices up because you're adding more fuel to the fire of demand, but we don't have more inventory. And so it's going to create a different set of issues. I am a firm believer in the program. I think the more funding we get, the more people we can help, but just be aware of the unintended consequences. We are going to see prices spike if this money comes back, especially at that level, because now we're going to see a longer duration, not just 2 weeks. We're going to see 4, 6, 8 weeks worth of time that money would last. That's great, but it means we're really going to see a spike in prices at that time. All right, next thing I want to talk about, are more banks about to go under? Here's the deal. The problem has not been solved. As a matter of fact, the next topic I'm going to discuss is going to be about the debt crisis and the debt ceiling. Here's the reality, though. Talking about banks failing, it doesn't impact even the people who are depositors on those banks. The federal government has already proven they're stepping in. The FDIC is going to cover any money that you have deposited with that bank. So you don't have a risk to say, oh my gosh, my bank is going to fail. They're going to shut down banks over the weekend. They're going to come back in on Monday morning and your bank's going to have a new name. So don't freak out. Don't make a big deal about it. It is not good for the economy. It is not something that I'm happy about, but unfortunately, it's part of the cleansing we're going through in this economic cycle. So people worrying, asking me, John, what's happening with these banks collapsing? It's just part of the process. And I don't mean to be so dismissive about it, but it isn't something to get very worked up about. Now, something to get worked up about, something to think about is what's happening with the debt ceiling. The debt ceiling is a very, very misunderstood thing. And what it means, how it works, and how it impacts you is something that not only is misunderstood, but really often wrong. So let me oversimplify this. The federal government, back about 100 years ago, said, you know what, we're going to put a limit on how much money we can borrow, because they get money in two ways. They get money from payments of income for taxes, and then they borrow money. And so they have debt. And that debt was capped at a certain amount and said, you can't, it's like your credit card company saying you can't have more than $5,000 owed to us. We're just going to limit you. Well, the problem is the federal government hasn't done a good job of keeping within that limit. And so regularly, Congress has to pass a law that increases that limit. Well, right now there is an argument between both sides of the aisle saying, look, I'm not going to get into political sides, but there's an argument that says we shouldn't increase the debt ceiling. We should decrease spending. And so it's creating a game of chicken where we are playing with the credibility of the federal government's ability to pay their debt. Now, how does this matter to you? Well, first of all, the Federal Budget Office, Congressional Budget Office, just came out this morning saying they think we're going to run out of money by June 1st. Okay, so they're saying there's a good chance that we cannot pay all of our debts starting on June 1st. We're only a few weeks away from that. If that were to happen, then the government needs to prioritize, just like you would if you don't have enough money to pay your bills. And you say, well, do I pay for my house payment, or do I pay for my utility bills? Do I pay my car payment? What is the first bill I shouldn't pay? Like, you still have some income coming in. You just can't pay all of your bills. And so you have to prioritize and say, which bill am I going to pay? And in that fact of prioritization, the biggest issue is a couple of things. The income that is paid to recipients of Social Security and other federal benefits, that could be one of the bills the government says that we can't pay that one right now. So, or they're going to postpone paying it. Well, how are you going to pay your bills? How's that going to impact the economy and your ability to pay your bills? And what are the ripple effects of that? Then the second piece is the federal government has to make payments on their debt or bonds, treasury bonds. Treasury bonds are considered to be the benchmark of all investments. Mortgage rates are typically a spread or somewhat higher than treasury bonds. And as treasury rates go up, then mortgage rates go up. As treasury rates go down, mortgage rates go down, because treasury bonds are considered the safest investment. The federal government will always pay you back. Well, maybe not. If they end up playing chicken and they lose and they don't pay their debt, then we will have major economic implications. There's some estimations that it could be as bad as the 2007-2008 crisis with the number of jobs that are lost, with the impact of the economy. The truth is this can be solved a lot easier just by Washington, D.C. getting on the same page and understanding that this game of chicken is not a game that is worth playing. How will that impact mortgages? We're going to have to see. The truth is there's an argument that says it's going to cause mortgage rates to go up. There's an argument that says there's a huge gap between the treasury and mortgage rates. And even if the treasury goes up, the economy is going to be suffering so much that mortgage rates are going to come down because investors are going to take money and out of stocks and invest them into mortgage bonds, and that'll drive rates down. I honestly think we're going to more likely see rates going down if this happens, but it is anybody's guess. But the other problem is we're going to have issues with like USDA loans and VA loans and FHA loans, because those are government-backed loans. Fannie Mae and Freddie Mac are not government-backed; they're just endorsed by the, or excuse me, Fannie Mae and Freddie Mac set the rules. They don't actually spend any money insuring the debts. So there's a lot of implications here that are yet to be determined. The bottom line is we just have to, A, sit back because we are passengers in this and recognize there's nothing we can do. But B, realize that the chances of this becoming a major issue are pretty slim. What is more likely to happen is the federal government could have a downgrade in their credit rating, kind of like when you're teetering on not paying your bills and your credit card company increases the amount that you have to pay in interest because your credit score dropped because you're highly leveraged, you're overutilizing your debts, and so it's bottom line. I don't want to drag this out. Don't freak out too much about the debt ceiling. We will see where it goes, but they're not going to just stop paying everything. They've got to figure out, just like if you lost part of your income, you've got to pick and choose what things you're going to pay. That's ultimately where the government's going to end up.